Well, the surprisingly strong January jobs report having ripple effects across the bond market. The U.S. Treasury yield topping 4% today as investors question when the Federal Reserve can start cutting interest rates. So let's get over to the CBOE where Rick Santelli is standing by. He's got a special guest for us here today. Hi, Rick.
Yes, hello. A very important guest. This is Casey Mulligan, economist, professor at University of Chicago, and he was chief economist under the Trump administration with the White House Council of Economic Advisors. Welcome, Casey. Beautiful trading floor, isn't it?
I love this, Rick.
All right, so today we had this whopper of an employment report, 353,000, up 0.6 on average hourly earnings. If you look at year over year, up well over 4%. But I noticed the work week took a drop to 34.1. And outside of COVID, that's the smallest work week in 14 years, and the data series started in 2006. Thoughts?
Anytime you have an outlier, that's subject to revision. Expect them to revise that. And that also has an effect on the wage because, of course, they're taking the earnings divided by the work week to get an hourly wage. So that's an outlier on the upside. I think we'll see those both revised more normal.
That makes perfect sense. It's just a numerator and denominator, and by changing the work week down with the same pay, it makes the pay look greater than it is. Now, the next topic, we've had productivity out this week, and productivity is acting quite solid, but yet there's lots of aspects to the economy that don't seem very productive to me, whether it's industrial policy or all the debt. The debt's huge. We're running 21% over last year, and last year was $1 trillion. So for the first 3 months, we're that much higher. Your thoughts?
Well, I'm a little less worried about the debt as long as these guys and ladies here are willing to buy it, and it seems like they are. The yields are pretty low, price is high. The demand is there, so it's a little bit hard to object to the supply yet.
Okay, and on the productivity front, do you see any flies in the ointment, or is productivity that solid?
Well, solid's not the way to describe it. We had terrible historical productivity in 2021 and 2022. And so finally we're recovering some of what we forgot how to do. But we're still not recovered to our previous trends in terms of getting better and better at what we do. The other trends we're seeing is out of private business and into nonprofits and into government. And there we can't even measure productivity.
So if you can't measure productivity, so there are distortions that get into the system. What about the value of the dollar? Even on a quite simple term, the value of the dollar is potentially the stronger it gets. That will have an effect on the output with respect to how they put together productivity, will it not?
Well, it depends on the sector. So it very much affects our sectors that export internationally, yes.
Okay, so international corporations. Now, next week we have 3s, 10s, and 30s, and that package is $121 billion. It seems like everybody pays attention to the auctions, and it's hard to dispute your thoughts. If they want to buy it, if they like cake, let them eat cake. But some of these auctions have been a little bit iffy. Is the Treasury going to keep a super close eye on this? It certainly seems to me that in the future, T-bill issuance isn't going to moderate.
Right, and they have a tough job trying to place all these securities. It's a massive amount that no underwriters ever had to place before, and they have a challenge in front of them.
Now, with respect to Janet Yellen and where they put the supply, where the maturities are, the market wasn't very happy that we didn't do more long-dated when interest rates were low. Is this now the norm that we're going to continue to see more T-bills than anything else if the Fed's going to be potentially easing? Your final thoughts?
I found resistance in the Treasury Department to that. We had talked about having maybe even consoles like Britain did during the Trump administration. Rates were low. They didn't like that.
I understand. Casey Mulligan, it's been a pleasure, Professor. Thank you for joining me today.